But today is COVID-19's impact on the labor market. I'm thrilled that we get to have Professor Morris Kleiner here, but I will not steal the thunder of introducing him. I will pass it off to Nick Stumo-Langer, who is joining us and is a 2020 MPP grad. And I will step back. My name is Keith. I'm the communications director here. I did not say my name, but I will pass off to Nick and I will let the conversation get underway.
Hi there, folks. I'm glad that you could join us for the lunchtime. So if you do see me eating any food, that's why, because it's my lunchtime as well. My name is Nick Stumo-Langer, like Keith said. I just graduated from the Humphrey Master of Public Policy program in 2020. And in my time at Humphrey, I was involved in the Public Affairs Student Association, the Humphrey Journal as well. So there's a lot of different ways to get involved, and I'll keep intro about myself brief, and just wanted to say that I'm really excited to have the opportunity to be here in conversation with Professor Kleiner. I took a couple of his courses, including Public Policies on Work and Pay and Multivariate Techniques. And Professor Kleiner, who is the AFL-CIO Chair in Labor Policy here at Humphrey, is a great resource on a number of different economics issues, labor policy issues, and he can do a much better introduction of himself than I can. So without further ado, here is Professor Kleiner.
Well, thank you, Nick and Keith, and thank you for the opportunity to talk to you about labor issues and economic issues. Just as by way of background, I've been at Humphrey for over 30 years. Seems like just yesterday. But been at Humphrey for quite a while and have taught classes in labor, which is my specialty, but also do quite a bit of work on general economic issues, and have for the last 16 years been part of the Federal Reserve Bank of Minneapolis, and that's been a great source of work for me, but perhaps more importantly, has been a really important source for students, in that a number of students have been able to find employment, either temporary or permanent employment, with the Federal Reserve Bank of Minneapolis, and also many of the other banks around the country. And also have spent time with the National Bureau of Economic Research, who really monitors the economy, and also spend time at the Upjohn Institute for Employment Research, which is based in Michigan. So have done quite a bit of work, and also spent time during the last administration advising the administration nationally and also a number of states regarding occupational regulation issues. And I'll be talking a bit about that as well. But again, just delighted to be here. And those of you who are looking forward to joining the Humphrey School, it'll be a great time. And although there's some difficulties and probably be some bumps in the road, given the current situation, I think you'll find it a most rewarding and exciting time to be at the Humphrey School. So look forward to greeting you either virtually or in person, hopefully in person, over the next several months and the next couple of years for those of you who are beginning the program. So welcome, most importantly. So I'm going to be talking about a couple of things, and you can see the screen.
Yep, looks good.
Okay, great. And those are a couple of us addressing one of the classes when I was gave a lecture at the University of Illinois, and Nick, and thank you very much. And Nick hopefully will be monitoring the questions on the chat line. And if you want to raise your hand, that certainly as a participant, look forward to your questions. A lot more fun to answer questions than to go through some of the lectures. So what I'm going to be talking about is sort of the flavor of the month, sort of what's the big issue. And the issue these days is the impact of a pandemic, and what effect has it had, who has it affected, And we're going to be talking quite a bit more about this over the next several weeks and months in terms of the class that I'm going to be teaching. So I want to just briefly mention some of the things that I'm going to be discussing in terms of the next hour or so is what impact did public policies responding to the healthcare crisis have on the labor market, including unemployment, wage changes, who did it affect, and how did government impact the healthcare sector, since that was the sector that was most impacted by the pandemic, and especially was it able to increase healthcare capacity by changing public policies, specifically changing occupational licensing policies that may have allowed nurses and respiratory therapists and doctors to provide services in the heat of the pandemic and in those hotspots. And finally, so what are the implications for potential recovery? My boss at the Federal Reserve Banks, Neil Kashkari, seems to think there's going to be sort of a U-shaped recovery, sort of slow. Others are arguing for a fast recovery. And what are the effects likely to have on income distribution and the ability of the economy to recover from a once-in-a-lifetime pandemic? So this is sort of, I know my grandchildren were asking me, well, what happened the last time there was a pandemic? What did you do? How did you respond? And I said, well, I wasn't even alive. As old as I am, I wasn't even alive during the last time there was a pandemic. So these are sort of finding our way through responses and both in terms of the labor market, health issues, and how might data provide at least some guidelines with respect to some of these issues. But first, I want to stop for a brief commercial break. And this is sort of my commercial announcement. And I'm going to be teaching a class this fall called The Labor Market Consequences of the COVID Pandemic. If you want to learn more about this, certainly be glad to respond. There's my email. And if you want to know the specific issues, it will have sort of an economics and statistics flavor to the class, but we'll be talking about many of these issues and hopefully be able to learn, and you'll be able to respond in terms of public policies and application of economics and statistics and cost benefit to this current issue. As I'm very fortunate in terms of having a number of people who will be helping me with the class, and they include sort of three key participants. One of them is Michael Osterholm, who's at the University of Minnesota. You may have heard of, you've seen him on places ranging from Meet the Press to podcasts like Joe Rogan. He's been on all of them. He's sort of done the full gamut. And he is one of the world's foremost authorities on infectious diseases. And he'll be starting out the class with some of the discussion of COVID and how likely it is to spread, and some of the ways that at least the health community sees the pandemic playing out. I was able to get one of my colleagues at the Federal Reserve Bank of Minneapolis, Alexandra Fogley. She is does work on macroeconomic labor force issues, how the labor force responds, to business cycles. And she's recently been focusing on how the labor force has been responding to the pandemic. Who are the winners? Who are the losers? And how are they gaining or losing as a result of these challenges? And finally, Peter Blair, who I was able to twist his arm. He's a co-author, and we've been doing work on occupational regulation issues. He's an economist at Harvard, and we've been doing work on the effects of ex-offenders and the effect of labor market regulation on ex-offenders. But he's more broadly known for his work on the labor force. And I'm fortunate enough to get him to also be involved in this particular class. So by way of a commercial, if you have the opportunity, I certainly would welcome you to the class. So what are we going to be talking about? What are sort of the issues? And one is sort of the labor market consequences of the COVID-19 pandemic. Why did unemployment rates spike to almost 15%? Numbers not heard of since the Great Depression. What were the policies that contributed to the decline, and what are policies that may have reduced to the extent that that was possible some of the decline or the rise in the unemployment, and what are the prospects for a return to pre-employment levels and wages, and for whom? So I know it seems like 50 years ago, but it was only February where unemployment rates were about 3.5%. Now they're 15%. It's been a very dramatic increase from robust economic activity to depression era levels of unemployment. So we're going to be discussing some of these issues, and I'll give you sort of an overview on these issues as part of our discussion this afternoon. So why is this recession different than others? So certainly as an economist, you like to look at other events that might have been similar, that unemployment spiked. You look at the Great Depression, you look at periods in the early part of the 2000s, 2008. And as part of that, what economists call the Phillips curve. And the Phillips curve was named after the first person who plotted this relationship. And it's basically trade-offs between employment and employment levels or employment growth and prices and wages. And the argument is that when employment is high, or unemployment becomes higher, wages and prices tend to decline. But when employment is very robust, that signals a high demand in the economy, wages and prices sort of take off. So is that the case in this particular event relative to others? And other recessions tend to be caused by changes in the business cycle. Certainly 2008 was caused by a financial crisis. Now we have a healthcare crisis resulting in a government lockdown in response to the pandemic. And what does the data show, and how does the current narrative about what's going on really show with respect to what's going on in the labor market? So these are a few of the questions that I hope to sort of get into and give you a brief introduction to what's going on over this time period. So the idea of this trade-off between wages. So in other words, as wages would tend to go up when employment is very robust, because again, it signals that things are pretty tight in the economy. It's very hard to hire workers, and it's also a signal that there's a lot of demand. If that's the case, wages go up, prices go up. And is there any recent evidence? So to some extent, this is some of the data from Raj Chetty, who is an economist at Harvard, and he's been getting some data together on private sector employment. And you can see in the 1991 recession that there was sort of a negatively sloped line. That is, and this is county level data, when unemployment was high, then employment tended to go down. And what happened, unemployment and income, you also found sort of a negative relationship. As the unemployment rate went up, then income was somewhat lower, and that there would be this negative relationship between wages and prices and employment. But in the 2010 recession, or really the sequel to 2008, the line was flatter. And in the current recession, there's no relationship, in large part because what were the causes? In 1991, it was sort of traditional business cycle effects. That is, the economy slowed down. It was a number of factors caused that recession to occur. It was sort of the beginning of the dot-com. There were a number of government policies. Similarly, in 2001, it was the end of the dot-com era. So that was another reason for employment to go down, and as a result, unemployment rates peaked during that period. But in 2010 and 2020, there's been sort of a flat relationship between the idea of the Phillips curve. So that really hasn't held recently. And a large part is probably due to the causes of the recession. So what have been sort of...
Quick question for you, Professor Kleiner.
Sure.
So you noted, obviously, there's all these different recessions in history, and I'm just thinking it might be useful to kind of lay out, you as an economist, how do you think about a recession versus how are people, in the media using the term recession, or how like the popular understanding of it?
Yeah, well, thank you. And the group that I spend some time working with, the National Bureau of Economic Research, they're sort of the arbiter of recessions, and they say that you have 2 quarters of declining economic growth is the definition of a recession. So they sort of mark that as being a recession, and that's sort of a decline in economic activity. And typically, if economic activity declines, the labor market is a lagging indicator. That is, what happens to the economy first, then it has an impact on what happens to people in terms of their jobs and wages and employment. So that tends to be the direction. But thank you for that. Certainly is an important issue, and one that's not perhaps often discussed. Now, in the current, what have been the policy responses to the current recession? One is the CARES Act, and the CARES Act is the Corona Aid, Relief, and Economic Security Act, which was passed in March, which provided protection largely for small businesses and individuals who are not at the top part of the income distribution. So smaller firms could keep people on, they could have loans from the government in order to keep people employed. And also they could share jobs. So there were a number of people who were, in fact, during this period, were sharing jobs, and they could claim to be unemployed, and the companies could claim them as employees so that they could get loans from the CARES Act, the largest part of which, about $350 billion, was the Paycheck Protection Program, which was part of the CARES Act. Another issue that came up was in those hotspots, New York City, Denver, Detroit, where there were super spikes in Corona. There was a response by the governors, and this is sort of state and local, to relax occupational licensing. And just to give you a background, occupational licensing is you have to have permission from the government in order to work, and that has grown in the 1950s from about 5% of the workforce to now about 1 in 5 workers, or 20 to 25% of the workforce requires permission from government to work. In the healthcare sector, it's well over 80% require permission from government in order to work. Why is that important? Because when you saw these spikes in the pandemic, what governors did, Governor of Colorado, Governor of Michigan, was to relax the occupational licensing requirements for nurses, for respiratory therapists, for doctors, for EMTs, so that they could get into the workforce much quicker. And it allowed for people from other states to move to those states without the requirements that you need to pass an exam in order to work in those states. So they were granted temporary licenses largely to deal with the spike in demand for healthcare workers. And finally, there was unemployment and welfare programs, and that was largely captured by the well over $2 trillion CARES Act. So individuals who were low income and small businesses were provided for and in terms of unemployment insurance. And in fact, if you were unemployed, there was an extension of unemployment. Also, you were given $600 beyond your unemployment insurance during the period of up to 4 months, and that just expired on July 31st. So that's what, if you're sort of a policy wonk, which I am, you sort of follow the to and fro's of the negotiations in Washington to extend the Paycheck Protection Program in order to cover the individuals who became unemployed, and to allow them to, especially as it was especially an important issue for individuals at the lower part of the income distribution. So those have all been issues in response to the pandemic. Now, there's sort of a few key dates with respect to the pandemic. First, the first pandemic case was in January 2020. The national emergency declaration was in March, and the CARES Act that I've been talking about was signed into law in the end of March. And that's when this $2 trillion stimulus package was put into effect. And a lot of folks really viewed this the equivalent of the Great Depression, the equivalent of war. And as a result, the response was a huge amount of money into the economy in order to take care of individuals who were at least economically affected by the pandemic. So the cases were really spiked during the latter part of March and into April, and the laws were really passed in order to deal with that. Now, what happened to the economy in response, or at least as a result of government-mandated shutdown? So this is largely what happened, some of it at the national level, but by and large, it was at the state and local level where governors and mayors in our federalist system required businesses to close, which is very different than the kind of recessions and depressions that have happened in the past, which have been largely a response to bank crises or housing crises or other factors that may have caused the economy to sink. This was really the government requiring companies to shut down, very different than what has happened in the past. So what happened is perhaps not surprisingly, is there was a big decline in gross domestic product, about 5%. Private domestic investment declined. Government expenditures increased, so there's a sort of a natural, as the economy goes down, unemployment insurance rates go up, the ability, welfare costs go up, so government went up, net exports went up, but personal consumption expenditures dramatically declined, and this is credit card spending, which also dramatically declined as people were locked into their houses. Retail sales tended to, this was what was going on prior to the pandemic, And food services up to March was sort of going along fairly rapidly, and then you'll see this very rapid decline and very steep decline as a result of the pandemic. So very clear evidence, and certainly the folks at the National Bureau of Economic Research were able to track this. And there is data now, there's government data and also private data, which is able to track these very dramatic changes that occurred in response to the pandemic. There were also very interesting changes in employment rates over time. So what happened, at least to workers who were able to work from home, like folks like me, and also teachers and government employees, they were able to keep their jobs, and individuals who were low-wage workers tended to see a very dramatic decline. So this is this green line showing the very dramatic decline in employment in April, May, and June of this year. And what happened is home-based employees or low-wage workers saw a very steep decline in their earnings, and they tended to rebound in May through June of this year. And accommodations and food services experienced perhaps the most dramatic decline. And again, it was very different. The individuals who were at the top, people who were in education, were able to keep their jobs. Individuals who were working in the government were able to work from home. And generally, they're at the upper 10% of the income distribution. The people who were working in food service and entertainment, those folks were at the lower part of the income distribution, and they experienced the most rapid decline in employment. So the pandemic disproportionately influenced or had an effect on individuals at the lower part of the income distribution. So perhaps not surprisingly, that was the effect of this very rapid shutdown in economic activity, mandated largely by the government. So these were all public policies. So one question was, did reopenings have much of an effect? And we're able to get some data for Wisconsin and Minnesota and what happened in terms of Wisconsin and Minnesota when they closed, everything closed down. You couldn't go anywhere. Minnesota opened a little bit earlier than Wisconsin, and states that reopened didn't seem to have much of an effect on consumer spending. So the fact that Minnesota opened a little bit earlier than Wisconsin, a number of operations were able to open, malls were able to open on a limited basis, restaurants were able to open on a limited basis. Relative to Wisconsin, it didn't seem to have much of an effect on employment. The lines were pretty much very close to each other in states that are often viewed as being twins. I know we don't like to think of that during football season, that the Badgers and the Gophers are twins, but at least in terms of economics, the kinds of activities that are taking place in Wisconsin and Minnesota are very similar. And when you look at what happened in response to the pandemic, there wasn't much of a change in terms of being able to reopen much earlier. One thing I might add is some international effects. So, for example, many people always bring forth the Swedish model in terms of the pandemic. Sweden, just as a quick background, closed partially. That is, there were a number of businesses that did close, but a lot of the restaurants were able to remain open. There was social distancing, but schools were open. Malls were kept largely their regular hours. And what happened was they declined in terms of economic activity, there was about an almost 9% decline in Sweden in gross domestic products. The green eye shades people of economists measuring that. But in Europe in general, the Eurozone declined by 12%, and the US, which declined, which schools were closed, restaurants were closed, the US declined about 10% over that same period. Now, the trade-off for that are the death rates. And death rates in Sweden were somewhat higher than in Norway and Denmark, but they were slightly lower than countries like Britain, Spain, and Belgium, which also locked down. So the ability of lockdowns and its effects, Sweden was able to keep economic activity at a higher level relative to other countries, but they suffered somewhat higher death rates as a result of the pandemic relative to its neighbors, but didn't do much worse than, or in fact did somewhat better than countries like Spain and England and Britain and Belgium. So kind of some trade-offs, but hard to measure. One thing, the trade-offs, yes, they had more death rates, higher death rates from the pandemic, but other unintended consequences of the lockdown were suicides, child partner abuse, the bankruptcies, lost opportunities in life. All those need to be weighed against the higher death rates due to the pandemic. My general jobs have been to provide the information, and the policymakers or the elected officials have the unfortunate job of making the decisions. I can sort of lay out some of those parameters. So what happened to employment? There were changes in hours worked. This is sort of the wage rates declined, hours worked declined as a result of the pandemic, but they tended to rebound, or they started to rebound in June. Certainly well below zero being what it was right before the pandemic. So we're nowhere near where we started, but there has been a slight rebound in terms of changes in wages and earnings as a result of a slight rebound in terms of wages, hours, and earnings over time as more businesses open, and to some extent the effect of the CARE Act and the PPP providing resources to people at the lower part of the income distribution. All that has been occurring. So one of the other issues that has come up is what's happened to employment by firm size. And this is an issue that's going to play its way out post-pandemic. And that is, you have companies like Amazon. First, they're just doing terrific. FedEx, Walmart, Target, very big companies. And they have been able to weather the pandemic. In fact, they've been able to gain from the pandemic. But smaller businesses have not been able to rebound. So that's been a real problem in terms of what might happen when we come out of the pandemic. That is, you're going to see much more concentration because a lot of these smaller businesses will have disappeared. So that's something for public policymakers to be concerned with as we think about what's going to happen in a post-pandemic world, given that the companies that have been able to rebound are the larger ones relative to ones that are much smaller. And the idea of the PPP, the Paycheck Protection Program, there's been a change in earnings. This is what happens by firm size. There was obviously April being sort of the big time of the decline in employment. There's been a change in earning by size of employment. And all these are really important issues that earnings, that the PPP had an effect of reducing hours. And this is something that's being debated right now in Congress. Right now, workers were able to, up till the end of July, were able to get $600 in addition to unemployment insurance. The idea was to make sure individuals had money, this sort of Keynesian approach of making sure people were and given that individuals at the lower part of the income distribution were those disproportionately affected by declines in employment, that this $600 was to make them partially whole. But the negative consequence is that individuals who were receiving those funds did not return to work. And that's something that's being debated. Should it be $600? Should it be $200? And how do we get individuals who are on unemployment as a result of the government forcing their companies to shut down? What should they get as a consequence? And that's an issue that, yes, it did decrease employment and hours worked as a result of this public policy providing income for individuals at the bottom part of the income distribution.
So a quick question,
Sure.
on that too. You know, you mentioned a few times that there are debates happening in the federal government around certain policy responses, and some things that I've been following have, you know, led people to assume that a lot of this decision making will get kicked down to the states, depending on the reopening, the support, any of those types of things. So I'm interested if you, as an economist, are excited, I guess, in some way to get that data to have some of these natural experiments, and what kinds of things are you going to be looking for?
Very good question, and thank you. Yes, that the states are doing lots of experiments, and as a researcher, it'll always be fun to look at these issues. Some states that opened earlier, as I mentioned, what happened to Wisconsin versus Minnesota in terms of opening earlier versus opening later, and there didn't seem to be much of an effect across states. There's certainly countries, Sweden versus the rest of Europe. How are they doing in terms of being able to rebound economically? And certainly different unemployment insurance programs. But largely right now, the PPP and the CARES Act are really federal programs right now. So that doesn't allow for some of the natural experiments that researchers would like to do. So there's some of the issues. Another big issue, and again, who has this pandemic, who has it affected the most? It's really had a disproportionate effect on individuals at the lower part of the income distribution. It's also had a disproportionate effect on kids or future workers and the development of human capital, which is also a major economic issue. And this is what's happened. This is a test that most public schools give in terms of math and our kids turning in their math assignments. And this was January, before the pandemic. This is when the pandemic hit. And this is kids whose families are in the top quartile of the income distribution. And the green line are kids at the bottom of the income quartile. And this is what they're doing in terms of turning in their math homework. And the kids at the upper part of the income distribution, yeah, they're taking a bit of a hit into April and early May, but they're not taking nearly as big a hit as kids who are in households whose families are in the bottom part of the income quartile. So this is another really important issue that public policymakers need to be aware of, that the pandemic is not affecting all families equally. It's affecting kids at the lower part of the distribution dramatically in terms of they're not turning in their assignments. They don't have perhaps parents who they can go to help them do third or fourth or fifth grade math, where the kids at the upper part of the distribution are suffering a bit of a hit by going online, doing the kind of stuff we're doing right now, but they've been able to pretty much carry on, but with a slight hit. So this is another issue that public policymakers need to be aware of in terms of issues, for example, opening schools, having kids learn at home. Yeah, upper income kids seem to be able to do that. The parents are on them. Perhaps they have more flexible jobs, where individuals at the lower part of the income distribution don't have as flexible jobs. They have to go out, and maybe grandma or grandpa are taking care of them and not doing such a great job and making sure they're doing their homework. And you can see before they were doing about the same. And this is perhaps the most dramatic effect of the pandemic, is what happens to education and kids.
So we did have a couple of really great questions come through in the Q&A. So again, if you do have questions, feel free to hit the Q&A button right underneath the slides. Mary Browning asked if there are other reasons why people haven't returned to work other than that $600 increase in unemployment benefits. And they're kind of surmising that maybe the employers haven't opened up either, and wondering if there's a way that we could delineate these numbers from each other.
Yeah, and I think that's a great question. That what in some cases they've been shut down by the government, or they've been in areas that have been disproportionately affected by the pandemic. Smaller businesses, smaller shops were not able to open. Certainly healthcare, barbers, cosmetology shops were not able to open. So they were disproportionately affected as a result of the mandates. And those mandates differed by state. Some states were allowed them to rebound quickly. Other states are keeping those small businesses locked down. And also issues, some people may not return because it's not safe. You're working, we had certainly a big outbreak of the pandemic in South Dakota. So those, until they got that cleaned up, until they had the right hazmat suits to work, those people were unemployed. So those are all particular issues, and what's going to happen to the nature of work after the pandemic crisis is an increasing in telework. Certainly, I would not have taught a class using Zoom 6, 7, 8 months ago, and now we're all teaching and we're all taking classes, and that's also affecting neighbors, at least people at the upper part of the income distribution, who don't have to show up, and they're not in manufacturing. They can do a lot of their work at home. And city densification of those cities. So why do you need to be so close when you can do a lot of the work via conferences, via Zoom or other forms, Microsoft forms of telecommunications, which allow, you don't have to be close. You don't have to be close to work, where it was a much bigger issue prior to the pandemic. A large firm consolidation. Certainly you're seeing a lot of firms buying up smaller firms, a lot of firms going out of business. So that leads to a lot of quasi-monopolies that may evolve after we get out of this, whenever that is. And automation, certainly robots and the ability of people to do a lot of the jobs let machines do a lot of the jobs that people did. That's also likely to occur to a much greater extent. So a lot of these trends would have occurred anyway, but what happened with the pandemic, it's really accelerating all these trends, which were sort of, it may have happened over 5 or 10 years, that a lot more classes are offered in public schools and universities that would have been offered online. This really magnified and intensified the ability to offer these classes online. So all these are particularly important issues that we're likely to see on the other end once we see light at the end of the tunnel.
Yeah, and we actually have another question, kind of
Sure.
ones that are a little related to this. Craig Taylor and then Amelia Quast. I hope I'm pronouncing your name right. Basically, Craig's question is explaining how the stock market has continued to perform modestly well, given the fact that we have a 15% unemployment rate. And then, sort of related, is that Amelia mentions that the PPP recipients are not returning to work, but they're also spending money. So they're floating the economy. So we might have an answer within 2 questions. And also wondering why the PPP recipients, are they just supporting Walmart and not the mom and pop shops? And kind of how does that work with the nature of work that you were just talking about?
Well, during the lockdown, there was examples in Michigan where a Target was open, and you could Target was open because they sold food, and that was viewed as essential. So in Target, you could go and get your gardening equipment at Target, where perhaps a gardening store was still on lockdown. They were a smaller operation. So the smaller operation went out of business, where a company like Target or Walmart, which was multifaceted and large, were able to keep their customers. In terms of the stock market is forward-looking. So they're looking at what's going to be going on a year from now, and they sort of see some sort of vaccine dealing away with the crisis. And as a result, they see that things are likely to rebound. So the labor market is a lagging indicator. The stock market is a leading indicator. So they're looking at the future. So if you were ever to have a crystal ball or Ouija board, the stock market would be it, because it looks what might be going on a year from now, not what's happened in the past or what's happening right now. So I think that's why the stock market is doing well, even though you have unemployment rates around 15%, and you have a lot of people who are suffering and have lots of economic distress. The stock market is saying, yeah, that's what's going on now, but they're sort of saying what is going to be happening 6 months or a year from now. So it tends to be a leading indicator. And I think that's the reason the stock market's doing well relative to the labor market, which is a lagging indicator. So I wanted to just to go through something that I spend a lot of my time doing, which is a case study and an application to healthcare. Certainly interrupt. I'm here to answer your questions. I don't have to get through all the slides. Is the issue of healthcare workers and what happened during the pandemic in terms of relaxing occupational licensing requirements. So in order to be a respiratory therapist, you have to go to school, you have to take exams. In order to be a registered or practical nurse, you need to go to school, you need to take tests. And before you do that, you can't do anything. Well, what happened during the pandemic in states like New York, Michigan, also in the Twin Cities, Colorado, is that because of the demand for these workers, the governors in Colorado and New York, other states, relaxed those licensing requirements. So what they did is said, in the state of Minnesota, allowed retired nurses who'd given up their license, they could come back to work, didn't have to retake the exam. New nursing graduates didn't have to sit for the exam. They could go, and they were issued provisional licenses for 60 days in order to take care of the large number of sick, ill, infected individuals who were showing up at hospitals. So they could provide and increase the capacity of the healthcare sector to provide for these patients. Also, states allowed individuals to move to those states, and they were able to go across state lines. And this was another, the ability of the states that had real large spikes in the pandemic, they were allowed to move across state lines, and this had an impact on increasing healthcare capacity and quality by allowing older people to come back, newer people to practice right away, and people to move from other states without having to sit for the exam, study for the exam, which would have taken weeks and months. They were able to hit the ground running. And this was one big impact of this crisis. And just to give you some illustration of this, about 25 states allowed healthcare services without completing new licensing requirements. That happened in Minnesota. 35 states allowed out-of-state healthcare practitioners to practice in the state, and 10 states allowed temporary or licenses for people who were either hadn't passed the exam or had passed the exam many years from now. They were able to hit the ground running. And again, did this happen? What were the effects? Because there was a healthcare crisis, hospitals were being inundated with people who needed respiratory therapists and nurses, especially physical therapists, EMTs, all those were in high demand. And this allowed temporary capacity increases by relaxing public policies. So
we did have a question related to that as well, too. Colette Salemi was wondering how the healthcare worker unions were responding to these relaxed licensing policies. You know, if there's any unified response or something that could be useful to kind of look forward.
Yeah, generally, again, it depends. But in Minnesota, for example, the nurses unions were not in favor of this. There were a lot of nurses, for example, who became unemployed. People who were doing optional care, people who were taking care of individuals who had hip replacements, knee replacements. Those are generally optional issues. They became unemployed because that type of hospital care or taking care of individuals were not allowed. They became unemployed, and the nurses union said, well, why can't they go and work in COVID issues and deal with pandemic issues? So that they generally opposed the relaxation of these licensing requirements. And some work I've done with Jason Hicks, and he's has done a lot of work on keeping track of a lot of these numbers and the data. Colorado, which relaxed a number of their licensing requirements, were able to get increases in the number of people who were directly dealing with the pandemic. So the fact that they were able to relax their public policies allowed both individuals who were at the border of being able to work, or allowed people to move in from other states, allowed individuals to practice in these states and increased healthcare labor force capacity. And my guess is it increased the ability of individuals who were suffering from the pandemic to be treated in a more efficient and effective way. So what are some of the conclusions? I see my time is running out. Certainly glad to take questions. Is that there was an unprecedented surge in the use of technology to accomplish tasks that could be done by persons. And this has permanently changed people's knowledge of and comfort with these substitutes. The way I'm talking to you right now, I certainly wouldn't have dreamed of talking to you this way a year ago. That's been a real change. Is it going to continue post-pandemic? That will be interesting to see. I'm sure some of it will continue. So there's going to be a real change in the way we think of providing services and the role of technology in the workplace, and how customers or patients can be served as a result of these changing technologies. Parents will continue to struggle This has been a human capital issue, a labor force issue in terms of the long term. Parents, how do you take care of kids who are home and you've got a job? Even if you're able to work on the computer, you're in a meeting and kids have to be taken care of. There's also issues of passing along the communicable diseases to grandparents who are likely to have very dire effects of the pandemic. So all these are issues that are likely to occur in terms of human capital and problems that are likely to occur as a result. And these are long-term effects. And the question now is how the labor market will be rebuilt post-pandemic. In its wake, there are likely to be massive reallocations in who works, how they work, and the kinds of jobs that they do, which I look forward to working with many of the students at the Humphrey School to see how things will look post-pandemic in terms of what might happen 6 months or a year from now, and how the workforce and labor force are likely to change as a result. So thank you very much for listening to this story, and hopefully we'll have opportunity to see many of you in classes over the next couple of years, especially for newer students.
Yeah, and we have just enough time, I think, for one last question, then we can wrap up. In a follow-up to the easing of the occupational licensing for healthcare workers, is there any indication of how many healthcare workers in Minnesota were actually affected by this relaxed policy, or are we researching that at the moment?
We're researching that. That's something we need to find out. Some states have kept up on this, and one of our future research projects is to see what happened in different states and the response to relaxations. One really nice thing is that some states changed their policies, other states did not. How were they able to increase their healthcare capacity through the labor force to deal with the pandemic and deal with the severely ill individuals in response to their relaxing of these licensing requirements, especially in healthcare.
Great. Yeah, so stay tuned, in other words.
Right, stay tuned.
Yeah.
Hopefully for new students, we'll have answers to these within a year, or certainly by the time you graduate.
I wanted to thank everyone for attending today. I wanted to thank Professor Kleiner for giving his time. I just also want to say, too, if anything in the webinar intrigued you or you thought was interesting, there's a lot of room for original student research at Humphrey, with a lot of professors, with anything and anyone you're interested in. So yeah, I think there's a lot of really great opportunities for, whether it's education policy, labor market, global policy, anything like that. So look forward to, answering questions, seeing people later on, because I'll still just be around the Humphrey School in some capacity, I'm sure. So thank you so much for coming today, and have a great rest of your afternoon.
Thank you, Nick, for being leading this seminar. Really appreciate it.
Yeah, happy to do it.